today is about this revised conceptual framework for financial reporting. So if you can see, why is there a revision of conceptual framework? So this is the overview, which is in revising the conceptual framework, the board sought to balance between providing high-level concept and providing enough detail for the conceptual framework to be useful to the board and others. So the board views of the conceptual framework as a practical tool to help it develop standards, and the conceptual framework includes concept that helps the board develop standards and also discusses the factors that the board needs to consider in making judgments when application of the concept does not lead to a single answer. So like for example, priority, it's identified as priority by stakeholders, and agenda consultation, so filing gaps, for example, guidance on measurement, presentation and disclosure, updating, for example, the definition of an assets and a liability, clarifying, for example, the role of measurement and uncertainty. And for the revised conceptual framework, a comprehensive set of concepts for financial reporting. So main changes are, for the new one, measurement concepts on measurement, including factors to be considered when selecting measurement bases, while presentation and disclosure, including when to classify, I mean, income and expenses in other comprehensive income, while the recognition is the guidance on when assets and liabilities are removed from financial statements, while updated definitions of an assets and liability, while recognition criteria for including assets and liabilities in financial statements. So to clarify, the broadens stewardship, measurement, uncertainty, and substance over form. Financial reporting, our objective of financial reporting, it is the user's involves decision about buying, selling, or holding equity or debt instruments, like providing or setting loans and other forms of credit, while voting or otherwise influencing management's actions. To make this decision, users assess prospects for future net cash inflows to the entity and management stewardship of the entity's economic resources. Also, to make both this assessment, users need information about both the entity's economic resources, claims against the entity, and changes in those resources and claims, how efficiently and effectively management has discharged its responsibility to use the entity's economic resources. Some are summary of changes. This chapter was issued on 2010 and went through extensive due process at the time. Therefore, in revising the conceptual framework, the board did not fundamentally reconsider this chapter. However, it clarified by information used in assessing stewardship is needed to achieve the objective of financial reporting. While in stewardship, users of financial reports need information to help them assess a management stewardship. The conceptual framework explicitly discusses the need as well as the need for information that helps users assess the prospects for future net cash inflows to the entity. While users of financial reports are in entities existing and potential investor, lenders, and other creditors. Those users must rely on financial reports for much of the financial information they need. So qualitative characteristic of useful financial information: for information to be useful, it must both be relevant and provide a faithful representation of what it purports to represent. Relevance and faithful representation are the fundamental qualitative characteristics of useful financial information and the guiding concept that applies throughout the revised conceptual framework. So for the relevance, information is relevant if it is capable of making a difference to the decision made by users, while financial information is capable of making a difference in this decision if it has predictive value of confirmatory value. While faithful representation, information must faithfully represent the substance of what it purports to represent. While a faithful representation also is to maximum extent possible, complete, neutral, and from error, or is affected by level of measurement uncertainty. For the summary of changes, this chapter was issued in 2010 and went through extensive due process at that time. Therefore, in revising the conceptual framework, the board did not fundamentally reconsider this chapter. However, The board clarified the rules of prudence, measurement, uncertainty, and substance over form in assessing whether information is useful. So enhancing qualitative characteristics are comparability, verifiability, timeliness, and understandability. These four qualitative characteristics enhances the useful of information, but they cannot make non-useful information useful. For cost constraint, the benefit of providing the information needs to justify the cost of providing and using the information. Statement and the reporting entity. For the reporting entity, an entity that is required or chooses to prepare financial statement, not necessarily a legal entity, could be a portion of an entity or comprise more than one entity. Financial statement, a particular form of financial reports that provides information about the reporting entities like assets, liabilities, equity, income, and expenses. Consolidated financial statements are a unconsolidated financial statement and combined financial statement. For consolidated financial statements, it provides information about assets, liabilities, equity, income, and expenses of both the parent and its subsidiaries as a single reporting entity. While unconsolidated financial statements, it provides information about assets, liabilities, equity, income, and expenses of the parent only. While combined financial statement provides information about assets, liabilities, equity, income, and expenses of two or more entities that are not linked by a parent-subsidiary relationship. Or this chapter is new. Determining the appropriate boundary of a reporting entity can be difficult if, for example, the entity is not a legal entity. In such cases, the boundary is determined by considering the information needs of the users of the entity's financial statements. Those users need information that is relevant and that faithfully represents what it purports to represent. A reporting entity does not comprise an arbitrary or incomplete collection of assets, liabilities, equity, income, and expenses. Information and disclosure. The statement of profit or loss, or the statement of profit or loss, is the primary source of information about an entity's financial performance of the reporting period. Profit or loss could be a section of single statement of financial performance or a separate statement. The statement of financial performance includes a total or subtotal for profit or loss. In principles, all income and expenses are classified and included in the statement of profit and loss. While other comprehensive income, in an exceptional circumstances, the board may decide to exclude from the statement of profit or loss income or expenses arising from a change in current value of an asset or liability and include those income and expenses in other comprehensive income. And the board may make such a decision when doing so would result in the statement of profit or loss, providing more relevant information or more faithful representation. When recycling and in principle income and expenses included in other comprehensive income in one period are recycled to the statement of profit or loss in a future period when doing so results in the statement of profit or loss, while providing more relevant information or a more faithful representation. When recycling does not result in the statement of profit or loss, providing more relevant information or a more faithful representation, the board may decide income and expenses included in other comprehensive income are not be subsequently recycled. For the better communication, information about assets, liabilities, equity, income, and expenses is communicated through presentation and disclosure in the financial statement. Effective communication of information is financial statement makes the information more relevant and contributes to a faithful representation of an entity's assets, liabilities, equity, income, and expenses. While the revised conceptual framework includes concepts that describes how information should be presented and disclosed in financial statement, the board is also working on several projects on the theme of better communication to make financial information more useful to investor, lenders, and other creditors, and to improve the communication of that information. While amendments of references of the conceptual framework in IFRS standards is separate accompanying document. Some standards include explicit references to previous version of the conceptual framework. These amendments update that those references so they refer to the revised conceptual framework. The board expects that the amendments to references to the conceptual framework standards will not have a significant effect on users and preparers of financial statement. While the amendments are effectively for annul periods beginning on or after January 1, 2020 with earlier application permitted. And the amendment should be applied retrospectively unless retrospectively application would be impracticable or involve undue cost or effort. So to avoid, this is the exemptions class, to avoid unintended consequences, acquirers are required to apply the definition of an asset and liability and supporting the concepts in the previous rather than revised conceptual framework. The board plans to assess how IFRS 3 can be updated without unintended consequences. Regulatory account balance when developing accounting policies for regulatory account balances. Applying IAS or accounting policy changes in accounting estimates and errors, entities are required to refer the previous rather than the revised conceptual framework. This avoids entities revising those accounting policies twice within a short period, once for the revised conceptual framework and again when a revised standards of rate regulated activities is issued. So that ends our class discussion for